of late, maybe from one of our competitors, that's suggesting that people or investment firms are clipping India and getting back into China. What would, because I noticed that you're still got a preference for India and everywhere else, what would it take for you to do the same thing, to go back into China?
Yeah, so we have a structurally negative view on China, and we would be selling into any sort of strength that we see. We think a few things. So it's hard to regain long-term investor confidence in China without a final resolution to what's going on in the property market. And we think, it's not easy to do, and that's why it hasn't happened yet. And so this is a precursor for us to become more positive. If you compare it to India, obviously China is on headline valuation is much cheaper, but if you look at India, you've got a much better transmission of GDP growth to earnings growth for the market. You've got more consistent earnings growth in India. And we think that these are some of the factors that lead us to prefer India, despite the higher headline valuation, versus China because of its structural problems.
Yeah. So when you say structural problems, you're obviously not convinced by the policy response we've seen thus far.
I think if you look at the market is also not.
But the intervention did, Kieran, the intervention that we saw from the regulators did help the market prop up a bit. So when we look at the intraday, or rather the year-to-date chart on the Shanghai or the Shenzhen, right? There's a bit of a recovery. I'm not saying that they've covered all lost ground because there's too much pain out there. But no, that's not what I was asking for. I was asking for the chart. But anyhow, you get my point, right? The point is, do you not think like a bottom has been put in place for things to stabilize from here?
Yeah, I mean, look, I think a couple of things. The market is so cheap that a little bit of positive news or lack of negative news can result in an outsized move in the market. So that's one thing. Serious institutional investors have exited. So a little positive news can go a long way. But you just have to look at the banking sector. The banking sector trades on low single-digit PEs, high single-digit yields, low single-digit.
That's the chart I was talking about. If you can just take a look at it. I mean, you know about it, but even so, yeah.
And price to book, about 0.3 times. There is an expectation that ultimately the banking sector is going to have to be used to be bailed in to bail out the property sector, and that's what's priced in the market at the moment. So we think we're not there yet. So this is the main reason why we don't have any confidence to go back into China in a serious way.
Just to cover, you say the serious money. What you mean is the long only money. So yeah,
because there's definitely trades
the hot money.
Sure, hot money.
That's still serious, but it's the hot money. So just
absolutely.
on that point, though, because I wanted to ask you and build out upon this. If you're thinking that India and Japan and everywhere else is a better bet than, say, for example, China, are you not tempted to take perhaps even just a small part, just to hedge that potential? Or are you not even there yet in terms of having a smaller allocation in a portfolio in China? Just in case.
Yeah. So, I mean, just when you say India and Japan and everywhere else, so we overweight on the U.S., overweight on Japan, and we like India and we buy on weakness there. What in a diversified portfolio, of course, we would have a small. We're a private bank, right? Yeah. We're in charge. We're not hot money. We will have a small exposure, maybe hedged in China, just in case something good happens. But we're certainly not equal weight or overweight in China.